Hello viewers, have I got a great new strategy for you today. Now a lot of traders out there, they're obsessed with the world of maybe trend following or breakout type strategies, even scalping, but there is another way. It's called mean reversion and it's very common, very popular in the professional trading world. It might sound complex, but it is very straightforward if you understand what it all means. And in this video I'm going to take you through what it exactly does mean, the mean reversion. There's some statistics and maths. We're going to put that into a Renko based strategy setup, all very well neatly laid out, rules, structure, all very simple for you to go away and play with. And we're going to put it into my favorite charting format, Renko, which takes it up a notch and another level. So with all of that, I think it's about time we got started. First of all though, we've got to do some learning. I've got to explain to you what mean reversion is. I'm going to talk a bit about statistics as well. Don't worry, don't panic. It's not going back to school lessons. It's really straightforward stuff, because if you can understand this, you can understand how the charts are working. So with that, let's get into those points. So bear with me through this bit, just a bit of old style learning now. I like to use visual graphics for that, and we've got in front of you the normal distribution bell-shaped curve. You may or may not have come across that in your past, but it's really a simple complex concept, and it helps explain what mean reversion is. And mean reversion is really just the statistical tendency of price to return to its average after an extreme move. Now, financial markets, where they oscillate, they stretch, and then they snap back. And when we measure that stretch correctly, we can fade extremes for high probability trades. So heading back to our normal distribution curve, just to explain that, what you can see there, around 68%, that's the purpley blue shade area, that's a 1 standard deviation move, full cluster, their outcomes cluster around the mean. And then we've got that yellow shaded area after that, that's a 2 standard deviation move, and that's saying 95% of outcomes cluster around the mean there. So anything above that is really a stretch. It's where the elastic band has really got stretched. And what happens, like we said, the price, if we're looking at financial markets, pings back towards its mean. And I get interested when I'm building these strategies with a standard deviation move of about 1.65 standard deviations, which is about 90% of the data outcomes will fall around the mean. So anything in that top 10%, that outlier zone, that's what I start to get interested in. And you guessed it, we measure that stretch in standard deviations, and we use something called the z-score to give us a number, so we can then turn that in our trading world into a meaningful set of rules. And like I said, I like to get interested around 1.65 standard deviations, where we're starting to have more of a rare event, and that's where we start to look for the price to fade back towards the mean. That's today's statistics class over. Let's take a look at the strategy so you can sort of see how it works before we dive into the nuts and bolts of it. So this is what the strategy looks like. I've got it set up here at the moment on WTI crude oil, ticker CL, 1 minute Renko chart on the left, block size 0.05, so that's 5 cents, so pretty quick. On the left hand side we got our execution window, on the right hand side we got some historical volatility, and that's going to help us with the block sizing, which I'll go through in detail in a bit. But just remember, block size, very important for this strategy to get it to work. So what's going on now? First of all, our concept of mean reversion. Hopefully you can see, if I just change the color here to something a bit more obvious, let's do it that way and make it really big. You see that big purple line going through the middle? That is our mean, and now I've set that to 20. There it is, just marked there. So that's the standard Bollinger Band setup, and what I've done is I've overlaid 2 Bollinger Bands on each other to create these extreme zones remember from our bell shape distribution, these zones here. That's when I'm hoping that the price moves from the mean and comes back down towards it, and as you'll see in these examples, quite often goes up away from it, hits the mean, and then carries through all the way to the other side, and then come ping along all day long, giving us mean reverting opportunities. So coincidentally, as I'm recording this, we've just had a live trade, and we can see that in this zone just here. It's played out. It's just it's just finished. I'll explain why it's just finished. But how would we have got into that trade? Well, we need this guy below here, and let me just mark on these two lines like this, plus and minus 1.65. Let's just tidy that up, make it 1.65. This is our Z score. Now this is most probably crucial part of the strategy. We need to know that stretch, don't we? So how do we do that? It's the Z score, and as you can see here, we've got this big stretch. So anything over 1.65, we expect it eventually to return back downwards, and anything under minus 1.65, we expect it to go back up and reverse back toward the mean. So in terms of price action right now, we'd be expecting it to come back towards maybe 64.25 cents. So that's the sort of general idea of it. So we're looking for those extremes in the Z score. So if we do have those extremes, how do we actually get into the trade? So simple rules. We've got our extreme going on down here, then we look up at the top, we've got the price action in the zone which happened, and how do we get in? Well, we've got this really fast moving average here set to 3.1. Once the price breaks that, we are in the trade. And then two simple rules to get out. We're going to break the trade in two, so you can keep it as one if you want, but statistically I've tested this, it works very nicely with this setup. So we follow the trade down, and once the price breaks back through the blue line, the moving average, we get out. So we'd get out, but the important thing, we get out half of our trade there, and this is where this stochastic indicator comes into play, because we leave half of our trade on and we wait until that crosses and moves back through the 20 line there to get out, and it hasn't quite got, so we've got this reversion here, and it's going to save us with the blocks flipping round and maybe trying to get us out on a false signal. So you can get one or two blocks the other way, because it might just keep on going down like that. So we got out of half of our trade here, so we've captured that band to band move very nicely, and then we've got another half of the trade with that extra move, and that's it. That is the strategy. And on crude oil, you can get plenty of trades per day if you get the right block size, but like I said, the block size is crucial to the success of this strategy. Plus, with measuring the Z score stretch, and then the timing entry in with those like extremes we've seen in the Bollinger Bands, and the timing in with the moving average and the stochastic. So let's get into the setup, the details, how you go about constructing this. Now this really is an important part of the strategy jigsaw to put in place. It's the Renko brick size method. So why do these block size matter and getting them right? Well, too small, it's noisy, you get too many signals, you get a low risk return. Too large, you're going to miss trades, and you're not going to actually get many trades for that matter. So the professional approach is to match the block size to the market volatility regime that we're in. So if we flip back to the chart very quickly of the strategy setup, and that is what this right hand chart is all about. It's the historical volatility of WTI crude oil. Now if I click onto that, you can see it's HV, historical volatility, just set to 10. It's on a daily candlestick chart. Now you notice that it's not showing because you don't need it. It's, remember, daily candlestick chart, and you can see how the volatility has changed over crude oil just over the last few months. You've gone down from lows here at 15-16% all the way up to highs around 80%. Then it's fallen down again and it's bounced around a bit and it started to pick up but then slowing down. So you can imagine a brick size up here is going to be completely different to a brick size down here. You're going to have, you know, a nice large one up there and a much smaller one down here to make the strategy work. So we need a rule set that puts that together in a systematic type approach. So we've got a three-step process here. First of all is measuring volatility. We've seen where we got it from. We got it from the charts there. We're using historical volatility, and that's annualized. Okay, big important point there, annualized. So that means it's, you know, if you read it off like we just did, 25%, that means that, you know, you're expecting the price from where it is today to move plus minus 25%. But the important thing for us is we need to convert it back to a daily amount first to get to our, you know, block size. So we read off the data, and today, you know, 23%, roughly around there, but like we saw, you know, it was nearly 80% not too long ago. So we then convert that to a daily price range. And how do we do that? Well, we just take the volatility and divide it by the square root of 252 or 260. That's the amount of trading days there to get our expected daily move, and we convert that percentage into price units. So in our example here, say WTI was trading around $80 and the historical volatility was 23%. That means our expected daily move would be $80 times the 0.23, that's the volatility percentage, then divided by the square root of 252, which gives us 0.73, which means, you know, we're expecting the price of crude oil on average to move plus minus 73 cents per day. So that's step one and step two, but then we need a final stage, which is to convert that into Renko blocks. Just to show you how easy that is to put into a spreadsheet, or how easy it's to calculate, here we go. This is our crude oil. We've got our annual volatility 23%, we got our price $80. You could put those two into boxes. Then our daily move in percentage terms, where it's just the annual volatility 23%, and you can see the formula up there, divided by square root of 252 trading days gives us 1.45%. And then what's the actual dollar daily move? Well, that's quite easy. That's just the price times the percentage move, giving us a $1.16 plus minus daily move. Simple as that. Now step three, the most crucial part, turning that volatility information, steps 1 and 2, into Renko blocks. So we've got to link that volatility to the brick size, and we've got to get it in the right regime. And what do I mean by regime? It's, well, high, medium, low volatility regimes equals different block sizes for, you know, different effects. If you use a very small block size in a very volatile regime, you're going to get a lot of signals and probably a lot of noise. So we've got to map, you know, the right block size appropriately. So I've sort of come up with this methodology here. So we've got to decide how many bricks per day it's going to be broken. So blocks per day is going to be broken down into. That's the daily dollar volatility that we calculated. So in our last example on WTI, that daily dollar volatility was $1.16. So I've looked at the charts, and we can see that the volatility is very low at the moment. Remember, it's down in the early 20s, when a few months ago it was up in the high 80s. So really we need a small block size to, you know, give us the granular, you know, signals that we need, you know, the amount of signals that we need to be able to day trade this type of strategy. So a quick calculation there, as you can see in point 3, the daily dollar volatility divided by 24, so it's 1.16 divided by 24 equals 0.048 cents. We round that up to a 5 cents block size. You're wondering, well, where to get 24 from? It's not random. It's backtest and refined that number in different volatility regimes. So I'm I'm going to show you a table shortly of how you can quickly come up with this across markets, not just crude oil, whether it's indices, gold, whatever. But just remember using large divisor B in low vol and a small divisor B, for example, like 8 in high vol. Now here's my table that I use to construct the blocks, that conversion. I've put WTI in there to give you an idea of what sort of block size look like, but you do the same whether it's copper, gold, S&P 500, GBP, USD, whatever. So on the left column we've got our volatility, let's call them brackets, so less than 10%. Remember this is annual volatility, 10 to 20%, 20, 35%, and so on and so on. And then we've got a B divisor that we put against them by the bracket. So at the moment, our example, we were at about 23% on crude oil. That would be divided by 24 in this example, which gives us a block size, from our example of about 0.048, and I round that up to the nearest cent, and I try and keep those block sizes very similar. I round them up so we're not chasing like really small points. That's silly, and you can often get into backfitting and messing around. So I try and keep them as standardized as possible, and then you could build out a whole table very easily, and now you've got it against the volatility regimes and a quick block size check. And there you go, that's our block size sorted. So we can now get back into the strategy, and let's go through all the finer detail. So quickly whizzing back to the indicators and setup, we got our Renko chart, 1 minute, and the blocks we now know are based off of historical volatility, which was the right hand part of the chart setup. We've got 2 Bollinger Bands on there with the settings 21.5, 22. Our Z score indicator set to 20, and bands for that stretch filter set plus minus 1.65 standard deviations there. We got the moving average of 3 with an offset of 1 for quick entry and quick scale exit. We got the stochastic set to 10.73. Remember, that's the second part of our exit strategy. And we've got the moving average set to 20. That's our mean target line in the middle of the Renko chart, and that right hand side was a daily candlestick chart that we hid, so we didn't actually need to see it, but we added on the HV, historical volatility indicator, set to 10 to give us our reading for the daily volatility that goes into the inputs for the block size. So let's quickly just whiz through the chart again so you can see where I got those indicators from on TradingView. I'm just going to click through the different indicators here. So you can see, start from the top left in our Renko 1 minute chart. You can see I've set the fixed block size there after working it out to 0.05. There you go, you can see that in the box there. Then the Bollinger Bands, 20 and 2, and the faster one there, 20 and 1.5. That gives us our zones. We got our 20 moving average in the middle, set to 20. We got the blue line there, that's the quick entry in 3-1 offset. Then we've got our Z score, and I just typed in Z score into the indicator filter, and it comes up. You just type Z dash score, you see the period there, 20, all very standard. Stochastic down the bottom, 10.73, and then over on the right hand side, as I said, hidden daily candlestick chart, but the historical volatility is set to 10. I've got that blue line on there, which is a 50 moving average. I just want to see whether it's below or above as well, to just get another idea of regime change. But that is the basic setup in terms of indicators. Quickly through the trading rules once more. Entry, we know it's our Z score. It's got to be in that zone, which is plus 1.65 for a short reversal, and then we're timing it in with the moving average 3-1 to get in pretty quickly, so those two have got to be in combination for us to get in, and it's vice versa for the short trade. The stops just behind the reversal brick low or high, which is about 2 bricks worth of stops. Exits, well, we scale when we cross back through the moving average 3-1, and remember that's to take off half the trade, and then we keep it going until the 10-7-3 stochastic cross to get out the rest of the trade. You can play around with that if you want the exit process, but you know, it's worked for this back test and this strategy. And quickly back to the strategy once more to show you what's happened since I've been producing this video. We started off with this nice trade down there, and then we actually got a second trade while we were producing the video there, and that was there, and we can see the two Z-score overbought and oversold zones. We can see the price crossing through the 3 moving average. We can have our stop tucked in down there, and again, you know, we could maybe get bumped out short from the trade on half of it in this one because it was a bit messy through this zone, but our stochastic kept us in all the way up to around about there, so we'd have profited nicely from that trade. And this has been tested, you know, back tested with that as the exit strategy, and you know, using that combo of, you know, the moving average and that. But like I said, you can play around with it yourself, but it has produced a set of results in the back test that are worth having a quick look at now, and it was very consistent, that approach, across other assets as well. So let's take a look at that now. Now remember, these are back test results, so they do look good, but in reality it could be a different situation, and that's one of the important parts of backtesting and going live with backtesting. It's not finished when you start going live, it's a process as well. But you know, it's encouraging signs here, and I haven't gone into too much detail with the stats for you, but you know, 63% win rate, profit factor, Sharpe ratio, all looking healthy, and the max drawdown not looking too bad either at 12R. Equity curve looks pretty stable. Again, you know, buyer beware until you start trading it, and you can measure that, you know, when you're trading live versus the back test results as well, to see how many standard deviations you're away from there. Maybe it's slippage down to costs getting into the trade, or some other variables. Maybe it's just errors from your own execution. But it's a good start though with those results. So let's just move into a bit of Monte Carlo simulation analysis. So in terms of Monte Carlo results, 10,000 runs, 180 trades. You can see there the stats, takeaways. Strategy shows pretty robust edge across runs. You know, even the worst case, you know, 5th percentile there, it's still strongly profitable. Distribution tight, which is good. Clusters between 68R and 112R. Drawdown risk extremely low at tested parameters. So the strategy looks to be resilient. In the portfolio context, this kind of, you know, too sharp profile, rare for, you know, retail accessible type strategy systems, and it does work very nicely and probably best on WTI due to clear band to band snapping behavior at low block sizes. So all very good there. But what about other markets? Let's take a quick look there. So if we base the analysis on Sharpe, you can see that WTI crude oil is the best mean reverting candidate in the short term. Gold also works well medium term. Indices like the S&P, yeah, sort of lean, trendier, but still tradable, but lower Sharpe, not that much though. For swing or longer holds, gold and soybeans smooth out better than crude, and that's just a few of them that are tested on. But you know, you can look at some currency futures as well in there that could nicely swing. But you've got to also, you know, with that right block size, you know, you're going to get in that time frame that, you know, something like FX works better in. So there you go, you've got yourself an industrial strength mean reverting Renko based strategy there that's great on futures markets, especially the WTI, you know, some of those other commodities like gold, S&P, soybeans for example. But feel free to try it on other markets. Foreign exchange, forex could also potentially be very good there as well. Let me know. if you use mean reversion, how you get on, what sort of strategy you use, what do you think of this one? Put those thoughts and comments under this video. Love to hear from you there. Now, if you want to get more into the Renko and developing your trading mindset so you're in the right place to really blast away at the trading game, then I've got you covered. Currently we've got a sale on 30% off all our digital products, and I'll put a link to that in the description below. That's all on the Renko book that I've got, a masterclass, and the Samurai Trading Code, a new book just out that gets your mindset very systematized into the right way of thinking for successful trading. Plus we've got paperback and hardback books available via the bookstore as well, so lots there to keep you covered. So if you've liked today's video, please give us a thumbs up. Don't forget to hit the subscribe and bell buttons for getting future notification on other content that I'll be producing. But thanks for watching, hope you've enjoyed it, and see you in that next video.